we have some new guests here tonight. So we want to have a special welcome to Sister Mary and Susan and Tammy. Thank you for coming.
Yeah.
This is your first time here. We've been doing this for 10 years now, the Pacer Investment Fund. So it's been a wonderful adventure for many of us and a wonderful journey. We have a former manager, one of our students, so Mary Grace made it as well. We have a couple of faculty members here. So feel free to follow along, ask questions. We'll certainly have time at the end to ask a lot of questions. Since this is our 10th full year as the fund in existence, I just wanted to give you some statistics. Over the last 10 years, the Pacer Fund has an annual average of, what did I say, 6.3%, right, every year. And the S&P 500 is around 7.2%. So we've been really close to the overall market. That includes, remember, 2008, where the market had a 31% decline. So overall, we've done very well here. Out of those 10 years, we've achieved our goals 7 out of those 10 years. So we've been very close to our benchmarks. We've actually outperformed the overall market for those 10 years. So we're on a very good track record. This was not one of our strongest years, but we'll talk about that in a minute. But in any case, this is all about the students. This is their year. This group is fairly new, as you'll find out. And so we want to have them to have the opportunity to sort of talk about what they did for the year and sort of showcase, and celebrate what they've done and what they've accomplished and what they're looking forward to in the upcoming year. So thank you all for coming. Dan, go ahead.
Well, welcome to the Pacer Investment Fund Annual Review. I'd like to introduce you to our managers. My name is Danny King. I am the student director. I'm also in charge of the industrial and utility sector.
I'm AJ Tratino. I'm the allocations manager and I'm in charge of the technology sector.
My name is Joe Hunt. I'm a full-time student. I'm in charge of the financial and healthcare sectors.
My name is Marywood. I'm a graduate student and I am the manager of international sector.
And I'm Zach Haney. I am the assistant to Dr. Comstock. I'm a graduate student and I am in charge of the consumer goods sector.
The retail and restaurant sector.
So our stated goal is capital preservation with moderate aggressive growth. We achieve that goal by trying to stay within plus or minus 3% of the S&P 500. Also, we try to have a risk level that's similar to the overall market. For our fund operations, we use a couple different methods. One method that we use is technical analysis. Another word for this might be charting. So we're looking at price charts over time. We're looking at patterns. We're looking at trying to predict future prices and future trends. Another method that we use is fundamental analysis. Now this is where we take a much deeper dive into the individual companies. We're looking at spreadsheets, we're looking at balance sheets, we're looking at income statements, even financial ratios. We're really looking at to determine the financial health of the company. We also use a little bit of Buffettology. Now Buffettology is a little bit of a mix of both fundamental and technical. To quote Mr. Buffett, we're looking for wonderful companies at wonderful prices. So what does that mean? So we're looking for companies that are financially sound. They look great on paper, but for some reason, the price is depressed. There's something going on either in the economy, in the sector, or whatnot. And we're looking, maybe that's the time, an opportunity to invest. Generally, most investors are running away from them, but that might be a time that's a good time to get in there. Generally, as a group, we meet monthly, and a lot of times it's in this room over at that table. Each manager is assigned to an individual sector of the economy. And they bring proposals, and we try to come to a consensus as a group. Even though they're assigned to that sector and they're studying the trends and everything that's going on, it's more of a group effort to whether we decide if it's really a good idea to invest in that at that time. We have a website. It's www.mupacerfund.org. You can go there and you can see our current holdings, as well as our past annual reports. We try to have a unified approach to doing proposals. So we do proposal sheets. They were introduced in 2010, and actually Dr. Comstock uses those as a teaching tool for his undergrads and graduate students. And every once in a while, he brings some of them to our meetings, and we may actually invest in them if the student really did their homework and it looks like they are a good investment for us. So right here, this is an example of our proposal sheets that we use. Pretty much we use reputable websites like Morningstar.com, Yahoo Finance, Bloomberg.com, and sites like that to generate all these numbers. You can also see it on the bottom. We do use a little bit of technical analysis here as well as a chart, and in this case we're looking at the price versus the 50-day moving average. Next slide. And here, the information that's on the previous page generates these key ratios. And in this instance, we're looking at 5 years of data and we're comparing it with industry averages. And we're trying to see, is this company trending better or worse than the industry and their peers?
All right, so looking at the pace from the year in review, we did see some pretty big changes this year. A lot of times when students graduate, they'll leave the Pacer Fund and we'll bring on new managers. So this year, the spring semester, we lost 5 managers and we brought on 4 new ones. So a lot of times with the new managers, they're not ready to take the big risk that some managers who have been there for a while. So the stocks they usually pull from are, they'll fall into the S&P 500. They're a little more stable. There's not as much risk when you take, or you pick one of those. Tend to stay away from stocks you'll see in the Russell 3000, which are newer companies. You don't know what's going to happen with them, and that's a lot of times where the risk come from. So they stay away from them for quite some time until they feel comfortable with the group and with making choices. And then the big question is usually always, did we achieve our goal for the year? So unfortunately this year, we had lower than expected results. However, we did maintain gains throughout the whole year. There were some unforeseen circumstances that happened with the presidential election. So right up until November, we were doing pretty well. And then once they elected a president, the stocks pretty much took off. But there were certain sectors that took off more than others. And as we go through, I'll explain more and show examples. And then also, in the beginning of the year, just to reduce some of our risk in our stocks, we put on stop losses on the majority of them. So in the event that we have a stock and it drops within the month between our meetings, it'll sell off automatically. That way we don't take as big a loss as we would have if we waited till the end of the month. So looking at our holdings, you can see between last year and this year, there were some changes. So the finance went from 18.6% to 16.7%. Now that was one of the holdings that when the election took place and the results came in, it basically went sky high. And you can see where we came down on the holdings. We weren't as heavy in there. Same thing with healthcare and the technology sector. We went heavy on the technology sector this year, and that was one of the sectors that didn't do as well as the other ones up until towards the end of December. And then our sector holdings, you can see here with our beta, which is basically the measurement of risk against the market. So a lot of them were lower than they could have been. So you see our beta was less. So if the market did a huge gain, we weren't going to see that result as much. So some of the ones, the industrial and utility sector, retail and healthcare, they were below 1, which shows that once that market went up in November and December, we weren't going to see the gains that the market itself was seeing. And then looking at basically our holdings this year, they're relatively all even. There are a few that are a lot larger than others, such as Digital Realty, Microsoft, Northrop, and Walt Disney. We can see we went heavier on those, and they actually did pretty well throughout the year, which helped us a lot. And then there's other ones that are lower than the others. Now, our year-to-date, our top three was United Healthcare, F5 Networks, and Digital Realty, which did extremely well, especially with the election. The F5 is a tech stock, but luckily that held strong through that time frame. And then our low, our three losers, I should say, was Mankind, which actually turned into a penny stock. They were expected to, they had a product that they expected to take off, but it did not, and it hurt their stock. Shutterstock is a fairly new stock to the Pacer Fund. We've only held it about 2 months. We bought it kind of high, and then from there, I mean, it hasn't really rebounded yet. It is starting to make a rebound. And then Chipotle has seen a lot of problems throughout the year. Yeah. So we held it, and then we sold it off, and then we bought it low again, and then something else came up with them, and it went back down. So that's what happened with those three. All right.
So you still have it?
Chipotle, yeah.
Chipotle? Yeah. You do?
Yeah. Hope I rebound. So now, next one's technology sector, and this is my actual sector. We only kept one stock throughout the whole year. It was IBM, which was chosen by an undergrad. It was on the Pacer Fund, luckily. Good choice. We did change all the other stocks we had. The biggest one that we lost was Apple. We had a stop loss on it. I believe it was around August when the market started to go extremely low for a couple of days. That's when we lost it. And if we didn't have it on there, we would have seen a lower number than what we had. Future outlook, it does seem like it's getting stronger. Now after the election's over, there's been some talks between the president, the future president, and a lot of the big tech companies. And then also looking for newer companies, we're going to look towards more data security. It seems to be getting extremely large. You always see something getting hacked into, or someone's data is getting taken. So it's becoming extremely important that people look to the best data security companies. And that's actually one of our possible future additions, which is the Palo Alto, which has a lot to do with securities, firewalls. And then also another future, which I'm still pushing for, is Facebook. So it had a good gain this year, and then again, it was affected like everybody else in the technology sector.
Okay, I'm going to go into the industrial and utility sector. You should recognize those companies up there. They're pretty big blue chip companies. We're seeing a trend, a couple different trends with the presidential election. There's a lot of talk with tax reform. So we think that's going to probably affect a lot of different sectors. But for the industrial and utility sector, we're probably looking at growth in manufacturing. We're also looking at growth in the defense sector with all the things that are going on in the world with the geopolitical things. That's probably going to remain to be a good sector to be invested in. The story of last year was there's a lot of oil, and guess what? There's still a lot of oil. Beginning in the summer of this year, OPEC had signaled that they're going to start to cut back production. They did a little bit. There are signals out there that they're going to continue that trend into 2017. So because they're such a huge producer of oil, them cutting back, even though it's incrementally, that should help push oil prices up a little bit higher. So we do want to be still invested in that space. Again, with the president-elect, it looks like there's going to be some loosening in some environmental regulations, at least domestically. That's probably going to help domestic mining companies, we believe, especially more up in the Alaska area. There's a big push, too, with the president-elect and this new administration for infrastructure spending. And that's really, as far as this year, we want to try to push and look at some of the big conglomerate industrial companies that get into big machinery and products that will help with the infrastructure for building. We think that's going to see a big trend upwards.
Okay, so as AJ mentioned a little bit, the financial sector was actually one of the sectors that took off during the election. Right before we had a meeting November 7th to discuss what we were going to do in regards to the election. Us, like most of the market, expected a different outcome with our election. which is why we went in the position with selling off some of the companies that we held. I believe Bank of America was one of them, some of the domestic banks that we didn't think were going to do as well due to the outcome of the election. Unfortunately, when Donald Trump won, the initial reaction was very poor, but then in the coming weeks, months, there was as much over the whole sector, there's almost a 38% gain in the banks alone. So we missed out on that. Fortunately, the outlook for 2017 and beyond with this new administration is it looks great. Consumer confidence is really what drove the increase in value in those stocks. Bank of America was one of the biggest winners because people felt very confident about what the president-elect was going to do. People were taking out loans. And right at the end of 2016, interest rates went up for the first time since 2008 as a reaction to the consumer confidence, people spending money, and possible inflation. And the Federal Reserve announced that they could raise rates as many as 3 times in the next year. So that just looks really great for the financial sector. Like I said, the new policies, less regulation and more spending is really going to drive up the prices in the financial sector. So we're really looking to take advantage of that sector very soon. Some of the companies, Branch Banking and Trust Corporation, it is a bank, but what's really great about it is it's a conservative bank. They do a lot of lending, more than some other banks. And then the other one is Fifth Third Bancorp. And what I really like about them is they're investing in local communities, which is something that the administration has said they're going to invest, President-elect wants to invest in America. So a bank that really wants to invest in local communities really just fits with the whole trend of following what the president-elect wants to do. In the healthcare sector, unfortunately, there's not as much certainty with the healthcare sector. As recent ago as a couple of hours ago, they were just, the Senate was interviewing the new Human Health Services Secretary. And I can say, personally watching it, didn't go too well. There's a lot of uncertainty in that room. There's a lot of uncertainty with what he's going to take on, dealing with repealing or replacing Obamacare. So the outlook for that is not as certain. But what we are certain about is there's a move towards value-based care. Really what that is moving towards, rather than just being a base price for if you were going to get in and get a hip replacement, then the hip replacement is going to cost a certain price, but the amount of time you don't go back, or the amount, just the overall health, is what's going to provide the incentives for the medical providers to give you a better value care. So that's a really nice place where the healthcare industry is going. And what we're going to focus on in 2017 is potential long-term holdings. Rather than looking at companies that might be coming out with a new drug, buying them, riding that wave as soon as their drug comes out and then selling them, we're going to look on things that have great financial health and good fundamentals.
I'm the new manager on the team and was responsible for the analysis of international sector. As you can see, 2016 wasn't a big year for the international market. Why? Because in the middle of the year, the Britain exited the European Union, and by the end of the year, the elections in the US affected a lot of the international market. But 2017 is expected for the growth of the international market. How? Because one, the new president is like having the relations with the Britain Prime Minister and plus Russia. So the combination of these 3 big groups will obviously increase the international market. Recently, the prices of the dollar also decreases, because of which the oil prices are going to increase, which is again going to affect the international market heavily. And the Britain Prime Minister Theresa also recently had made a speech and was saying that she wanted to completely take the Britain market out of the European Union, which is obviously going to trample the European Union market as well as the British market. But obviously, they would have some plans behind that to support the British market to be stable again. Plus, China is also looking forward to all these things, so they are making a lot of investment in the Asian market because they don't want to be left behind out of the scenario. So I think 2016 will be a good year if we look in the big markets, like looking forward for the China and how the British companies try to come up, plus the Russia and the US.
All right, so now we have the consumer goods sector. So we revamped the consumer goods sector a little bit. We got rid of some of our bigger holdings that we've had for a while, like Nike was a big one we decided to sell this year, and decided we went for the alternative of Adidas to go for an alternative brand there. But unfortunately, things did not really, as you can see by all the red that's up on this slide, things did not go very well in the consumer goods sector this year. Amazon was one of the only, that one might not be an accurate number actually for Amazon, because what happens because of those stop losses that we had, we sold off Amazon, I think maybe in October or so, and then we bought it back. So that's only since the end of the year that return for Amazon. So it actually was much better than that, but that's just what is reflected up there. Unfortunately for the consumer goods, our investments were badly timed. We had a lot of companies up there that were showing a lot of long-term growth, very steady, up over a year, maybe even 2 years. But as soon as we decided to invest in them, they decided that that was the peak, and they went down. So, but the future outlook for the consumer goods sector is very good. The economy is continuing to improve little by little, and including this year. Unemployment is going down, wages are going up. So people are going to have more discretionary or more disposable income to use on consumer goods. And with the election of Donald Trump, if his policies prove to be, implemented, they will also help to improve disposable income with more jobs, hopefully created by for infrastructure, increasing of infrastructure. Having the tax cuts for businesses to allow for more money to be used on employees and for wages and for more jobs. So in general, discretionary or disposable income should increase, allowing for consumer goods to grow, for people to have more extra spending money to spend on consumer goods. But the consumer goods sector, it is important that we need to look for companies that have a big digital presence. A lot of sectors already have taken advantage of the fact that our commerce is slowly shifting towards the digital world. Consumer goods is not really there yet. So if we can find companies that utilize the digital aspect and technology, then we'll be able to see some growth there. And also our society is becoming increasingly individualistic. So customizable products are the thing right now. People want stuff that's just for them. They don't want mass-produced things that's something that everybody else has. They want something that is for them, especially the younger generations. So customizable products is something we're also going to look into. And our country right now is becoming increasingly fit and active. So we're thinking of also investing in fitness companies like Fitbit or other athletic companies potentially, or maybe switch out Adidas, maybe hold them, but trying to stay in fitness, and also then luxury items, because the more your income goes up, the more you have for those things. You might not necessarily, if you didn't have as much money, you wouldn't buy something, kind of like with Tiffany, you wouldn't buy something that's fancy, but now that the economy is getting better, then we would spend more on those luxury goods. So that's where we're looking to head.
Looking at the retail and restaurant sector, within the past year, we've really moved from being a full retail sector to a restaurant sector. As you can see, Disney is our only retail holding at the time, and this is due to the increase of online shopping. As you saw, we have Amazon in our other sector, and that is really hurting the retail industry. Many companies, such as Macy's and Sears, are closing multiple locations. I believe it's the Limited is completely closing and going to go all online. So that really hurt the retail sector this year. As the year went on, we kept switching to restaurants and really making that switch. With that being said, there is a projected 3.7% increase for this upcoming year. So with that, we're going to look more into restaurants that provide quick service and are technology savvy. As you know, McDonald's already started making that switch this year, including Wendy's and a few other restaurants. A lot of restaurants are trying to make it convenience for you, so you could go in, get your stuff, and leave. With increased interest rates and tax cuts, they could really benefit this industry as a whole. As you can see, I'm the one who introduced Chipotle back into this, so maybe reconsidering that in this upcoming year. The future direction, we do believe it will be optimistic this upcoming year, with an expected growth of 2.1% GDP, and oil prices expected to go up. That'll really help our industrial and manufacturing. And then, of course, we have increased job opportunities with that manufacturing increase. The wild cards for this year are definitely the political influence. this will deal with the international and what companies that the U.S. will really be involved with this year. And then, of course, the increase in interest rates as well.
Okay, so future directions for the PACER Fund. With the Trump administration promising lower taxes, lower regulation, more spending domestically, we have the Fed promising that they're going to be raising interest rates, even though incrementally. Sectors that we think are going to benefit from this, the finance sector, industrial sector, tech sector, and we think also the consumer goods sector. Even though they got beaten up, there's probably some areas of opportunity there that we would like to invest in. We also like to revisit our stop loss strategy. This past year we did implement that, and we did lock in a lot of gains. The only problem with that is when a stock falls and we have the stop loss in, yes, we sell that off, we keep the gains. But if that stock comes around and swings up, we're going to miss out on all that gains. So this year we're probably going to implement a little bit more forecasting, price targets, and even limit to buy orders if we can. We're also going to monitor our beta. Right now our beta is at 0.89%. Generally the overall market is about 1. And as they stated before, the beta is a measure of risk and volatility relative to the overall market. So basically, if the market rises and we have a beta less than 1, we're not going to rise as much. And conversely, if the market does go down, we're not going to go down as much. That's a more conservative way to do it. But for us to see better gains this year, we're going to have to take just a little bit more risk, but we'll take it incrementally and carefully. Well, I mean, that's it. I want to thank you all. I could say, at least for myself, I've learned a lot, and I tell these guys I continue to learn. And I know for the new students that are on this year, I know they're learning quite a bit. And really, just thank you for the opportunity here. Is there any questions that you have tonight?
Great.